Hello everyone, this video is to provide a quick overview of state and local taxation. First, we want to get to this concept, tax nexus. So this is a unique concept in the state local taxation. So what is a tax nexus? Really, to put it in a simpler way, all it's trying to solve is how to establish the tax jurisdiction or tax authority for a particular state. So, in other words, the question uh, is a business subject to taxation in a particular state? This tax could include income tax as well as sale and use tax. There are some overlap between the income tax nexus and sales and use tax, but there are some differences as well. So, really, from an income tax perspective, the general rule is a commercial domicile will be the default determination. And if the commercial domicile is not applying, then the income tax's next rule will apply. So the public law 86272 will kick in. So to help determine whether the business has nexus to to a particular state in terms of income taxation. Sales use tax have something similar. Sales tax nexus, particularly we're looking at sales tax nexus, and really we're going to focus on whether there's a difference between the physical presence versus economic nexus. Of course, the physical presence will be the default. Then, if there's no physical presence, the next thing is the economic nexus, really whether the business has any economic activities within the state. So tax nexus, it's a super important concept in the state and local taxation domain, is because it establishes the tax jurisdiction for a particular state, for a particular business. The second part of this chapter we're really focusing on is how to determine the state income tax liability. So, in other words, if a business has to file a tax return in a particular state, what's the starting point, and what are the factors the business has to consider. Similar to individual state tax return, for uh, the business state income tax, they also need to consider the federal and state tax adjustments. So start with the federal and then layer on the tax adjustment related to the state. And the next thing, which this is it's very unique for the business, is there is apportionment, the business income apportionment, and as well as for the non-business income, there is a specific allocation. So a lot of times when you hear the apportionment in the context of state taxation, really what they're trying to say is how do we allocate the business income across the states which the business may have a tax nexus. So how to determine the apportionment factor is, generally speaking, they're using the property factor, sales factor, and the payroll factor. There could be a different methods depending on the state, but generally speaking, three factors is considered for the purpose of determine uh, the correct business income apportionment to a particular state. Okay, the key terms in this case, I'm going to quickly guess through the terms. A commercial domicile is the state where a business is headquartered and it directs operations. This is similar to the physical presence. So this is where the business is headquartered and directs operations. So by default, where the business is domiciled will be for that state, that business will be subject to taxation. The nexus is something it's beyond the commercial domicile. So the nexus is a sufficient or a minimum connection between a business and a state that's subject to the business to the state's tax system. So in other words, the nexus basis is another way to establish the tax jurisdiction in a particular state for a business. And the sales state and sales use tax is a big deal because just like individual taxation, anytime you go to the store, you had to pay the sales tax. For the business is the same thing. And however, from a business perspective, they're also functioning as a withholding agent. They're going to collect the sales tax from the individual consumers, and then they turn around and submit to the state government. So the question really has come down to uh, is a business required to collect the sales tax in that particular state? So this is something. It's a super big deal, especially for the state, which does not have any income tax. And our focus will be on the state income tax because is our course is focusing on income tax specifically. From a business perspective, they must pay income tax in their state of commercial domicile, and they must file income tax return in states where they have income tax nexus. Again, so the commercial domicile or income tax nexus establish the tax jurisdiction uh, over that state, for the business. The public law is something is basically supersedes state level factor presence nexus standards. Basically, provides an exception to the nexus rule. An economic nexus is an assertion by the states. So business generally must have a physical presence in a state to establish income tax nexus with that state, and with the exception of Public Law 86272. However, many states are currently asserting a business without a physical presence in the state may establish an income tax nexus if it has an economic presence in the state. So the economic presence, that's the next line of defense for a state to establish the tax jurisdiction for a particular business. There's factor MTC factor presence next standard specifically uh, explains the economic nexus. Okay, now we're switching gear to the income tax reporting. So a lot of the business they operate across states. So they're not maybe they're headquartered in Wisconsin, but the business can operate in outside of Wisconsin. They can operate in any states outside of Wisconsin. If that's the case, they're dealing with interstate business activities. So the question comes down to say, okay, do this business have to file an income tax return in a particular state? If if the business has a physical presence or establish an economic nexus in that state, then they are subject to the state taxation in that state. And the general rule for the state income tax reporting is start with federal taxable income, layer on any state tax adjustment, uh, any items which is not conform to the federal. Then they start with state tax base. Once we have the state tax base, there will be two portions. One is the portion of business income across the states with nexus. So they will apportion this business income portion across all the states the business has a nexus. So this includes all revenue earned in the ordinary course of a business. So generally speaking, will be the sales less cost of goods sold and any other expenses. And the non-business income, which is anything does not is not considered as business income, will be allocated specifically to a particular state. So, from a state taxable income perspective, there are really two sources. One is a portion of business income. The other one is allocated a non-business income. So I have attached the tax form 2024, Form 4F and Form N for Wisconsin. You can take a look. So, of course, each state, their tax return will be designed a little bit differently, but generally speaking, they have all these components reflected on the return. So you can take a look. And what is the common federal state adjustment? Generally speaking, they will remove any state and local income taxes, state and local bond interest income from the bonds in other states, and remove any federal dividend received deduction and add the state dividend received deduction. And then they will add back the federal income tax refunds, any intercompany expenses associated with related persons for a separate return state. And for state, there are also a separate depreciation system in some cases. The federal makers depreciation will not apply. They're adding on the state depreciation. Some of the items will be excluded from the state income, includes the U.S. obligation interest income, foreign dividends gross up, and a state income tax refunds included on federal return. So again, all of the adjustments are used to derive the state tax base before the apportionment and allocation. And for entities included on a state income tax return, this is something it's similar to the consolidated return a concept at the federal. So the business could choose to file a separate tax return. So that means that will require only those business with nexus in a state to file an income tax return. Uh, the business can choose to file a unitary tax return. So in this case, companies not filing a federal consolidated tax return can also become a unitary group. So unitary tax return group include all members meeting the unitary criteria, whether they have a nexus or not. And the states west of the Mississippi River and Illinois are unitary return states. So some of the state adopt unitary tax return uh, filing system, and some of the state adopt the separate tax return filing system. And the Supreme Court identified as three factors that can be used whether to determine whether a group of a business is unitary. So this is kind of gets to a little bit more, depending on the functional integration and the centralization of management and economies of scale. So all of the factors determine whether a group of a business is unitary or not. So the unitary concept pervades activities in the entire income tax system, including computing taxable income, computing apportionment percentage, and the determined tax return filing requirements. So for us, the calculation we're going to do is either at a separate uh, tax return level or unitary tax return level. As far as the rules goes into which business should file as unitary, that's something it will be beyond our scope of the text. So this is just for our information. And the calculation what we're going to do for this chapter is going to focus on how to do the apportionment and based on apportionment formula. What are the factors? What are the apportionment factors? So generally speaking, there are three factors going into the apportionment formula. There's sales factor, property factor, and a payroll factor. So each factor will be determined based on a specific rule, and the the allocation of non-business income is normally specifically there's a specifically allocation rules. So for interest and dividends, the allocation will be done to the state of a commercial domicile, except interest on working capital, which is business income, which will not be a part of the allocation. And the rental income will be allocated to the state where the property generating the rental income is located. And the royalties to the state where the property will be used. Uh, that's very similar to the sourcing rule. Allocate the capital gains from investment property to the state of a commercial domicile. And allocate capital gains from selling rental property to the state where the rental property was located. Again, this allocation of non-business income rules a lot of times is very similar to the state sourcing rules. And there's also some non-income based taxes, which is beyond the scope of the tax. We're not going to look at it in detail, but since we're talking about the local and state tax, just something to keep in mind. At a state and local level, there could be some other tax which has nothing to do with the income tax or sales tax, but it serves a specific purpose. And something for your information. From a calculation perspective, when you look at the homework, really the homework is surrounding the issues about the state apportionment. So how do we apply the apportionment formula to determine the taxable income at each state? Taxable income at each state. So a lot of times the information will be given is what is the overall apportionable income. So that's the portion will be apportioned across the states based on the formula. The formula depending on how it is, right? It's either a three factor, average, or it's double weighted sales factor in three factor. In this case, basically what we're saying is the double weighted sales factor. All it's saying is we're going to apply a double weighting on sales rather than have equal three factor. Some states they may use a single factor, but depending on what it is. So really, apportionment formula is a kind of like a description of the weighting on the three factors. And then the allocable income is specific to the state. It's basically there's no apportionment. This will be allocated strictly to the state, and the apportionment will be apportioned based on the apportionment formula. So take a look at this worksheet. This can be helpful for you to work on the homework for the apportionment. And the last piece, the calculation we're looking at is to run through a quick state income tax return for a unitary group. So unitary group is similar to the consolidated group filing. All we're doing here is we're identify all the members in the unitary group, and we're gonna identify each the income, the factors for each of the entity, and we're gonna do the same thing for the sales and property payroll. Look at those factors and to figure out the apportionment factor. The default is apportionment factor is the three. Each factor play 1/3, 1/3, 1/3. So that's the default. And then once we come up with the apportionment factor, we can we can apportion the business income to each of the businesses. The allocated income, the same thing. We're gonna allocate for each of the members. Then at the end of the day, we're gonna come back and have a total reporting for the single unitary group. So then the state taxable income is also a combined number, and that will apply to that particular state tax rate, then figure out the state tax liability in the state. So really what we're doing here is where we're trying to calculate this is single unitary group income tax in a particular state, state X. So we're looking at each entity and look at uh, their particular apportionment factor related to this particular state, and to come up with the total uh, state income tax liability for this unitary group. So again, come back for the state tax local taxation chapter. We cover a lot of concept, but again, the key is to understand this concept nexus. What is nexus is doing, and what are the special rules? And from a calculation perspective, really we're going to focus on how to do the apportionment calculation. What is the apportionment formula? And once we understand that, then we can do this calculation for it's a quick calculation for a state income tax reporting for a particular business. Start with the top federal federal state adjustment, then we're going to do the apportionment and allocation for the state, for a particular state. Then we get to the state taxable income, apply the state tax rate to get to the state income tax. So again, there's a lot of different pieces here, but the focus of the calculation for this chapter will be on state apportionment and state income tax report. That should be all, and thank you for listening, and have a great day.